Dan Weiskopf, ETF professor. I am also the portfolio manager of Block and proud member of the investment committee at Toroso, and also lead ETF strategist for the ETF think tank. I'm going to wear 3 hats anyway. So with that, I'm going to punch over to David and let him continue.
How's it going, everyone? We should have a very good show today. My name is David Jakanski, portfolio manager of the SoFi Gig Economy ETF, as well as the Amplify Inflation Fighters ETF. Today, we'll be talking all things volatility, which should be very interesting in today's markets. We know what happened with the Vixx products years ago. Obviously, the world of the ETF continues to innovate. So we'll be talking about the latest and greatest and what's going on in the overall volatility markets. I'll pass it off to Cynthia.
Hi, everybody. Cynthia Murphy, head of research for the tank. I'm glad you guys are all here. I hope you brought your drink, and I'll kick it to Jim. Jim, introduce yourself. Tell us a little bit about yourself, and then Stuart, it's all you.
You'll be sorry. I'll leave it up to Stuart. Jim Carroll. I am an advisor and portfolio manager at Toroso, and also an advisor to Mr. Barton's entity, and the Vixxologist on the Bird app. Here to try to light it up.
Yeah, thanks,
Stuart.
Jim. I'm Stuart Barton. I sort of wear 2 hats. I'm chief investment officer to 2 companies. One, Invest in Vol, manages volatility strategies for individuals through separately managed accounts, and we've been doing that for probably 6 years now. But perhaps more interestingly, I'm also chief investment officer of Volatility Shares, which is a newer company that has just recently launched 2 popular Vixx ETFs. I say popular because they're effectively very similar to 2 very popular structures that existed previously and that were retired.
Structure is the word, everybody, in case you weren't aware. It matters that we remember that word.
Where to go,
If there's
Stuart?
any doubt, Dan picked the word for today.
And on the theme of structure, Stuart, I have my first question for you. What happened with the old Vixx products?
Well, I mean, starting right from a top level, obviously we know the 2 popular products that were retired were Credit Suisse products. They were Credit Suisse ETNs, so exchange traded notes rather than exchange traded funds. They both kind of left the markets for slightly different reasons. The XIV product, which we know from years ago, 2018 February, we saw a spike in the Vixx and the Vixx futures, which led to the product near zeroing and eventually being delisted and closed by Credit Suisse. That was a minus 1 times Vixx futures ETN. And then the other product that was popular, also Credit Suisse product, was the TVIX, and that was a 2 times Vixx futures ETN. And then that sort of ran into I think there's a lot of kind of speculation about why it may have been delisted by Credit Suisse, but ultimately what happened was, as we went into COVID, volatility spiked dramatically. And I think the size of that ETN got to a point that perhaps Credit Suisse thought it would become difficult to manage, or perhaps there were other reasons, but ultimately they delisted it, and the thing has dwindled and pretty much disappeared now. So yeah, those were the 2. That was a 2 times Vixx future. So you can imagine how that did during late February, early March 2020, as COVID was kicking off. I think, if I remember, it went from something like $40 to $1,000 in today. I think it touched $1,000. It just amazing performance.
Convexity.
Yeah, and sorry, I'll ask one last question just because I haven't done this research myself and I find it super interesting. So I know one of the things that's like core to Toroso's belief is like, as new products come to the market, it changes the way that asset class might move in tandem with other asset classes. And so what we saw the first go around of the launch of Vixx products was a massive contango in the market, like upwards of 70% when the products got really, really popular. And that was a phenomenon that didn't really exist before the ETP products. So my question is, what happened in like the year and a half after the aftermath? Like, did that disappear entirely? Like, what is your thought on all of that? Yeah.
Yeah, I mean, it's a very good observation, because what was noticeable is after Feb 5th, 2018, after the XIV disappeared, there seemed to be a less persistent contango in the VIX futures market. Now, that just because there's a relationship there, I don't think we can necessarily say which caused what. So there's a tendency for people, investors, to be interested in a short product like that if the contango is strong. So it's possible that the interest in those sorts of trades, that type of structure, led to contango falling. But on the other hand, it could be the opposite. So it's difficult to say. I think it might be reasonable to say that when there is a large interest, either long or short, in the VIX ETPs, that it may bring about a more persistent or stable contango. So it may be stably flat, it may be stably inverted, but I think what happens is as the ETPs become perhaps more interesting to investors and their AUM goes up, they hold a bigger percentage of the futures, and that may drive a level of persistence in the shape of the curve.
Cool.
Yeah,
So,
it's very tough to say what chicken or egg situation. That's it clearly Feb 5th was an event that also changed the way people think about VIX markets, right? It was 2016, 17 was this period where people were saying, well, you could short a VIX type ETN or a VTN that shorted the VIX futures, and it seemed like it was, you were making money on a daily basis. And what people then sort of got to wake up to, I think, was, hang on, that it's not just make money every month out of this. There's risk, real risk, and that changed people's views. So yeah, that might have also changed the way people think about the entire VIX ecosystem.
So I'm going to ask a curveball question. I can start with softball or curveball, whichever you want. Sure. My curveball question is, and you can tell me I'm totally wrong or I'm like off base. I had a debate with somebody about Bitcoin, who's a portfolio manager, last night over dinner, and they're like, "There's no present value analysis using Bitcoin, right?" And I bullshitted my way through, kind of an argument. Is there a present value analysis to the VIX? Why does it have value? Is it a similar argument to Bitcoin?
So I'm by no means very knowledgeable in the Bitcoin space.
It's not relevant. Bitcoin doesn't matter, really.
Yeah.
Bitcoin doesn't matter.
But what I would say is there is probably more of a present value argument, like a real spot value argument for the VIX than there is for Bitcoin. In that you could easily see, let's say, for instance, any crypto going to zero, and that's fair. I think that would be a more difficult argument to make about VIX, because it's a reading taken from the price of options on the S&P 500 and so on. There is this there's this link that says, well, in order for VIX to have that sort of move down to zero, you would have to be implying zero volatility for a bunch of options in the S&P 500. Would options really price at zero on the S&P 500? And I think the reality is, unless we're in some strange situation where the market was closed, permanently for several months, could options ever be worth zero, and could implied volatility be zero? I think the answer is really no, except for in those very, very, very extreme cases where, at that point, the market structure's broken and fallen apart. So,
basically, you need the future to be certain. So if the Fed owned enough of the S&P 500, then maybe the future would be certain. So,
well, I think there's another element of it too, Dan, which is that and there are a lot of ways that people can choose to quote unquote insure their portfolio. But, you know, one of the use cases for VIX futures is as effectively portfolio insurance. The flip side of that is that some people and some people want to be buyers of that insurance, and some people believe that it's profitable to be sellers of that insurance. So there's an ecosystem around that insurance element of the volatility complex that I think, you know, gives it maybe not a you know, future discounted future cash flow value, but, you know, sort of an intrinsic value as a piece of the hedging infrastructure.
So after you know, the first March 2020, the pandemic hit, and then all the Credit Suisse ETNs closed, all the, you know, the drama, and, you know, they say we learned hard lessons quickly. So do you see today are investors approaching VIX investing differently? Like, how are they implementing VIX through ETFs today? In any way different than before, or are we still approaching it in the same way?
From what we see, I'd say not much has changed. That people have perhaps learned there's now more history, there's more to know, but the actual approach has perhaps not changed. What has changed is perhaps people's trust in ETNs. So there's been the Credit Suisse products were both ETNs, kind of had problems for complex but slightly different reasons that we could get into. But then, you know, even more recently, the problem with the Barclays VXX product, that, you know, there's this sort of, I think people are starting to realize that, yeah, the ETN wrapper is great, and it works for many things, it's convenient, and but it also has disadvantages, and some of those disadvantages are you know, it's effectively just a credit note that you own, and you know, the bank could one day default on it, for instance. That doesn't happen, but you know, it's always a possibility. You're also at the whim of the bank's decision. If its risk management decides we're not in this business anymore, we want to get out, you know, they can call it and close it. So I think there's been a realization that perhaps the ETF structure is better than the ETN structure. You know, I wouldn't make that statement, but I think, yeah, what we hear from clients is, oh, yeah, we've had some bad experience with the ETNs. Yeah, and I think that's perhaps what people are sort of taking away from this.
Oh, Stuart, you're being so polite. ETNs suck. Suck. The SEC should shut them down. They're bad. I'll be, you know, if you want to call them structured products, that's fine, but they're, you know, they're not ETFs, and they're opaque, and I just wish they would shut them down.
Yeah, I mean, I have to be polite. I was at Barclays and right at the beginning in the US. I was the first equity derivatives trader in the US, Barclays, and you know, from that grew you know, the structured note program that Barclays have today. And yes, I mean, I think there are a lot of uses for them, but I think as you point out, there are many areas where they're not the most suitable wrapper for something.
Well,
Oh, no.
and in fairness, and as a former user of several said products while they still existed, if you understood how they were constructed and how they operated, they actually, for the vast majority of the time, did what they were designed to do and did what they were set up to do. They had some shortcomings, and I'll toot his horn because he's probably not likely to do it. Stuart and his team at Velocity Shares in getting
Volatility shares.
Volatility shares, Velocity Shares. Oh, my bad. Volatility Shares in getting two new products through the SEC. A big part of their effort was to engineer better structures for those products to address some of the shortcomings of the forebearers, if you will.
Yeah, I mean, I think there's always opportunities for improvement, and what's quite amazing about the US financial markets, capitalism in general, is this ability to continually improve, replace, and grow. And I think of what we're doing in the space as sort of a Vixx 2.0. Everything before what we did, or pretty much everything, was based on the original idea. It was an index that was constructed early on. It was an index that was probably never designed to be used by inverse and leverage products. It didn't sort of think ahead to how rebalancing would have to happen if ETNs and ETFs were linked to these sort of indexes. So, I think it was about time that we had a rethink, and and we were part of that. We spent a lot of time with the various teams of the SEC that had concerns, and to be fair, helped us get to a point where people got comfortable, and hopefully, I'm not going to say that our products are ever going to be perfect, but I hope that it's that next level of evolution, and we've got some ideas down the road to kind of bring more innovative approaches and sort of new exposures that I think the market wants, that weren't possible before.
Yeah, I think a lot of people forget that just as long as like as recent as like 18 to 20 years ago, all indexes weren't meant to be investable universes. They were just indexes, right? One of the biggest switches that occurred on that end was 2004, the switch to float adjusted market cap as opposed to just market cap allocation. That was one of those small light switches that kind of changed everything in this industry. So can I ask you, do you have any outlook on the current VIX or overall volatility environment? And I'm going to expand that to a category including fixed income. One of the phenomenons that we're seeing as of late is heightened, increased volatility levels on the fixed income side of the table through something like the MOVE index, where we have a little bit more of muted volatility on the equity side of the table through VIX. And apologies if you don't want to go beyond VIX, so you can just say next question too.
Yeah, I will avoid making forward-looking statements. I think the market prices things where they believe they should be. I'll avoid saying much more. Maybe Jim's got a stronger opinion than that, or can express one.
Yeah. So look, there's clearly everybody's got a crystal ball and none of them work. One of the things that I observe is just going back, to the 90s when VIX was introduced, and 2004 we got VIX futures, and then we started to get exchange traded products. So, it's hard to go all the way back to the beginning of VIX and say that's the same information content that we have today, because obviously the options activity in S&P 500 is much more robust than it was in the 1990s. So is VIX today the same as VIX was back then? Probably not. Having said that, one of the things I keep an eye on is just literally stupid simple 1 year moving average of the VIX. And when the 1 year moving average of the VIX gets above 20, and remember that's about the average for VIX, and the mean or the median is more like 18, there's a tendency for the market to experience disruptions. If you go back to the mid-late 90s, you had the Asian contagion, you had the Russian debt crisis, and then you had the dot bomb, the tech wreck, whatever you want to call the internet collapse. And then things quieted down for a while, and then we got the global financial crisis, and then it quieted down. And remember when you used to just buy the dip? Well, that was a period of time when that moving average, for what it's worth, was below 20. And, basically whatever dip happened was worth buying. COVID took us back up above 20. We dipped below it very briefly. We're back up above 20. Does that mean that we're going to have more ruckus in the markets? I don't know. But to me, all it is a condition. It's not a trigger. It's not a trade signal, but it basically to me says you shouldn't be surprised if the market continues to have some disruptions in this period. I mean, that's what elevated volatility, that's what an elevated VIX futures are implying, above average moves in the equity indices. And you mentioned the MOVE index, it's gone through the roof. And, you know, by any measure, volatility in the bond market is every bit as big as volatility in the equity markets right now.
So Jim, let me see if I get this right. So after 20, you have like a more of a cautious volatility stance, right? Like it's a lower Sharpe ratio environment, right? The second it hits 20. And then what's the reverse trigger? Is it waiting for it to go all the way back down below 20, or is there some other change in environment that you're seeking there?
You know, it really does depend on somebody's, you know, investment time horizon, right? Because I could, you know, I could point to opportunities to trade one direction or the other in any of those regimes, the low vol regimes, the high vol regimes. So, you know, I think the all clear signal, you know, seems to have a coincidence with that moving average line going back below 20. You know, again, you know, it's kind of slapping a moving average on a chart and saying, does this, you know, is this really cause and effect, or is this just kind of helpful? And I think it's probably helpful. Again, we're dealing with a relatively small data set when you're going back to the 90s with a 1-year moving average. So I don't want to, you know, this is no holy grail, but it seems to be helpful.
I'll apologize ahead of time to both Dan and Cynthia. I have a lot of questions, so you guys can both text me and tell me to shut up.
Can I just ask one thing before you go deeper? I just want to, so is the best way to look at the VIX, and this is a very dumb question, as more of a real-time indicator? This is happening right now in markets and the VIX reflects that, as opposed to a signal of what happens next or how turbulent things are going forward?
Well, you know, again, so the construction of the VIX, and we can get into a debate about the construction of the VIX, and God forbid we get into things like skew. You know, the construction of the VIX is meant to be, you know, implied volatility looking forward 30 days, right? So it's a fairly short window, but it is meant to be, you know, here's what people expect over the next 30 days. And, you know, you can, again, one of the shorthands, take the VIX and divide it by 16, and that's what, you know, sort of the implied daily move in the S&P 500 is, right? So if you've got a VIX of 32, people are expecting the S&P to move 2% a day. Well, is that actually what's going to happen? No, almost certainly. But, you know, when the VIX got to 87, 89, whatever it was in March of 2000, you know, were people really thinking the S&P is going to move that kind of number every day? No, they were just in complete freak show.
And you'd think events such as companies ceasing to provide accurate or real guidance, and Feds around the world deciding to collectively pause on giving guidance would add more volatility into the near future, but apparently it hasn't. I actually have a question for us.
Yeah, real quick, David, what you would expect, and we've seen it, is that, you know, outer levels, you take the VIX futures term structure, you know, the outer months, you know, are stuck at what are historically high levels. And so, you know, people are basically saying, I don't know what the hell's going to happen with all this, you know, Ukraine, central banks, inflation, food shortages. So I'm just, if you want to buy insurance from me, you're going to have to pay up.
Yep. So 2 questions, and I'll ask one of them. I'll start with just one. The change in the composition of the S&P 500. How much does that affect, do you think, the volatility here, right? Like we have less tech, more energy, right? If you just kind of look at it that way in a more muted environment on a broad market cap weighted index, does that in theory just make some sense that it's just the composition of the index a little bit and the risk in the change in sectors muting the overall volatility market?
I mean, I think that's a good observation, and of course it does alter it. I think the factor to look at is the correlation of the products, the 500 stocks. So, you know, if you had 500 stocks that all correlated 100%, obviously you're in what would be the most volatile environment you could be for that set of stocks. If the 500 is made up of stocks that have got ideally some sort of negative correlation, and you've got a situation where the index itself then would actually, volatility would be dragged down by that effect. So the internal correlation of the basket would be important. If it became dominated by one sector, I think that then you could argue, well, you know, this would have an increasing volatility effect on it, even if that sector was a low volatility sector, because it would have this ability to drag it up and down in any particular direction on any particular day.
But the VIX calculation isn't taking into account like a correlation matrix across stocks, right? So
no, it doesn't. So, but what would happen was, I think if S&P 500 suddenly changed to 500 tech stocks because tech became the 500 biggest thing. I mean, I think in that situation you say, well, those individual tech stocks have all got a volatility. That volatility may be higher than a utility, but it might not be. But the important thing would be that how correlated are all those stocks? If all these stocks are all kind of doing the same thing, they're selling product or services related to the tech industry in the US. Yeah, I think in that situation, what you'd find is you would expect realized volatility in the S&P 500 to be higher, and that would bring about investors willing to pay more for the options, which would push up the implied volatility, which would push up the value of the VIX. So, you know, a VIX on an S&P full of tech would print a higher number, yes.
So Warren Buffett told me that I'm supposed to be greedy when everyone else is fearful. So market explodes, right? And like now's the time to go look at inverse VIX. What do I do if it's in 10% backwardation, right? Like that, because that's what investors see, especially novice investors. They get to it, they're like, great, the VIX popped. Oh shoot, I'm in 10% backwardation. Like, can you talk us through what like moving from 10% backwardation, 10% contango does to an investor who's like waiting for that VIX to move as these things change? Lots of loaded questions there, but take your pick.
Actually, I think I'll let Jim answer that, because
I'm happy to get started on that. So there are a couple different kinds of pain that can be inflicted on investors, right? So what everybody has figured out is that when the term structure is in contango, you want to be short volatility because, you know, that's a no-brainer. That's a moneymaker. Sorry, structure. And back in 2017, that was a great ride, being short volatility in one of various forms. You could be long the inverse product back then, as XIV, SVIXY. You could be short the long one. You could be short TVIX or short UVXY or short VXX. The challenge in that environment, and everybody talks about, you know, picking up pennies in front of the steamroller, is that a real shock to the system can happen quickly and can take your position and destroy it almost overnight. In a more pedestrian sense, the term structure can stay in contango, steep contango, but if something negative hits the market, the whole term structure can lift 2 or 3 or 4 or 5 points. You're still in contango, but David, you told me I was going to make money when it was in contango, but you know, I opened my computer this morning and I'm down 15% in my short vol position. So, you know, this is an ecosystem of that requires real study of how all this stuff fits together and works. And it is not a buy and hold environment. There is really no buy and hold trade with any of these volatility products. I refer to it as juggling nitroglycerin. There's a very real risk that you will either blow yourself up in the short trade, right? Because all of a sudden something terrible happens and the term structure lifts and turns backward and your position gets destroyed. Or you bleed to death, because if you look at a chart of any of the long volatility exchange traded products, they go from upper left to lower right with a few little blips where they made money. So it's a trader's market. You need a structure. You need a strategy. Damn it. And I hope I answered your question.
So I'm going to go to yes and no questions. Okay. So
good idea.
Yeah, no. And this is because I'm going to be like a little bit on my pulpit here. VXX is still open in terms of its trading, but it's closed in terms of creations as of now. That's a yes?
Yes.
Yeah.
Yes.
Okay. The math on what it should be valued at should be clear, right?
Yeah, it is. It's published daily, even in real time.
And it's published daily and it's real time. So my issue is if it was open in terms of creations, and theoretically trading properly, right? And everybody had an Excel spreadsheet that could see exactly what the NAV is and how it should be trading. What would happen at the moment when it was trading at a 5% discount or a 5% premium? Because my problem is at this point in time, assuming all things are equal, the credibility of the ETN structure is shot to hell. Maybe this isn't a Vixx conversation, but why do you think the SEC doesn't shut this down, all ETNs? Because this is a problem for all ETNs, because at the end of the day, they are a complex product set. And at the end of the day, part of my issue on all this is a bank borrows from retail, does whatever they want to do with a stated goal of providing a product that should trade aligned with whatever math exists.
Well, I mean, and I think everything you said is probably there's some truth in all of it. So your question was, what is likely to happen? At the moment, the creations are still closed, as far as I know, as far as I've read to date. If creations opened, theory might tell you that people would sell it back down to theoretical value, because they could then go and create whatever they've sold short in the creation mechanism. So in theory, there would be an instantaneous arbitrage window open. You'd say, I can sell this thing for 10% above its fair value, and then I just create it in the evening, and I made my 10%. There are reasons why that might not quite come about. I mean, there are information flows that may be slow. They may open creation windows and people don't know, and it takes some time. There's a limitation on how much trading capital will go and chase that opportunity. It's possible that there's a bunch of people who want to do it, but they're only going to throw 20 million bucks at it. So that's what's going to happen. So it could take time. I mean, there are other concerns, and then you pointed them out. You could theoretically wonder, well, they've closed creations on me before. Do I want to go short it in size? Like, do I want to do $500 million of this thing and then run the risk that I go to that window tonight and they say, sorry, there was a problem with that. We're not going to be able to do that. And then you're in a whole world of pain. So I think there are some practical concerns there. But I think we know what the theory says, and we'll have to just see what reality bears out.
Cool. Is there a question from Eric Connolly? I don't see it. I'm sorry.
He's got his hand up.
Okay, Eric, ask away, man. Go for it.
Sure. This is in the same vein as your question, Dan. Barclays has said that they're going to normalize the creation redemption structure for VXX. As that happens, what happens to the premium? And second, on a related note, I imagine the natural hedge for VXX is a Vixx product. How does that hedge ratio get calculated by the risk managers? Thanks.
I mean, I could probably take that. I think that the first part of that question is what I answered previously, which is, in theory, you might expect the premium to absolutely vanish. So you've got the ability to have a look at the NAV at the end of the day for VXX that's published, but there's also an intraday indicative value that gives you some idea that that's at least, they'll have an indicative value calculating agent be calculating that in real time in the background, so you can get a sort of real time feel for where that premium sits. And last I looked, and I haven't looked at it in a while, but it seems to be maybe it's a 10% premium, something like that. So in theory, you might imagine that 10% would come out if the window was normalized or reopened. In terms of what would be the hedge for it, again, the ETN is a formulaic product that pays off a formula which is published in the prospectus. You can back out exactly what that is and the two assets that it references. I mean, they are the first and second month Vixx futures. And there's a ratio, whether it's 50-50, 60-40, there's a ratio depending on where in the month you are. So somebody wanting to trade the arbitrage, with the theoretical arbitrage that we discussed, would theoretically then be selling that VXX at this sort of premium that they have measured, and they would be buying the exact futures portfolio, Vixx futures portfolio, as the hedge. That Vixx futures portfolio isn't static; it changes each day. So it would mean you would put the hedge on just as Barclays are each day, and you would roll it each day. So there'd be a little bit of maintenance involved. But in theory, then you would have the portfolio that is the true value, that tracks the true value of VXX. And then the VXX position you have would be the premium, inflated, deflated, whatever it is. But and I guess you'd be looking for that convergence of those two prices.
There's been a bit of a Twitter dialogue going on this topic for those who are interested, and somebody we know has been trying to help people understand it. Vance Harwood at Six Figure Investing. He's had a bit of a dialogue going over the last few days. So I think anybody who's interested in what some of the possibilities are around VXX might want to track down that Twitter thread and see what Vance has to say.
Yeah, they should just close it. Sorry, that's my opinion.
Well, I mean, you joke, but I think having
I'm not
worked
joking,
at
by
that
the way.
bank and at many banks, the problem, I guess, would be looking at these products have cost them a lot of money, and it's been in the press. There's hundreds of millions of dollars, close to $1 billion, and by the end of the day, it might be more. I've got to imagine that Barclays are looking at this stuff and thinking, is this key to our business? Is this worth taking this much admin risk? I mean, I don't know what the risk, the operational risk that they've just been through, and who knows? So I would not be surprised if we came in a few months and they said, "Oh, like we're delisting it. We're done."
Reputational risk.
Yeah,
they look like dodos.
Well, I think that ship's already sailed. I mean,
yeah,
I think,
yeah.
yeah.
Well, and it's not unlike the situation faced by Credit Suisse in March of 2000, when TVIX hit $1,000, and I forget, Stuart, it was 8 billion of AUM or some crazy number.
Yeah, I think in today it was over 8, and I think, correct me if I'm wrong, but those sort of numbers. And the crazy thing was they were in a situation where they had a note linked to the Vixx issued that had an AUM of about 2/3 of their market cap. Now that must be an interesting situation for Treasury and the internals within that bank, particularly in that situation. They're a Swiss bank that happens to have a US securities business, a note issuance program, and all this sort of thing. But, at the end of the day, their core business, I'm guessing, is more about wealth management in Switzerland. And to have 2/3 of your market cap issued in a 2 times Vixx notes may have woken up a few people in the C-suite to, what are we doing? So that's pure speculation there.
You're covered by disclosure. Don't worry about it.
A little bit of an off-topic question, but what other volatility markets have liquid futures trading? Is there anything else out there that has any liquidity in that space? Literally nothing.
No. I mean, you could always access volatility via hedge portfolios of options, and that's traded in most major markets globally. And even in single stocks, so you can synthesize it, but in terms of a listed future, I think there are a few others that are just really illiquid. So we've got futures now listed on the Spikes index, which is a SPY volatility. Which is kind of an interesting take because it's very similar to Vixx, but it's not the Vixx. So you've got that going on. And then Jim, what are there's some Vol Q, that's right, which are
on the NASDAQ 100.
Right, and those, from what I remember, those are something odd about those as well. They're sort of a non-hedgeable future. They're a future that's linked to at the money vol or something. Yeah, I read about them years ago, and so, I mean, to answer your question, no, there's nothing that's got any meaningful liquidity in it yet. I mean, maybe there'll be some innovation, but not yet.
So can I ask a bad question? I'm good at these questions today. I don't know. Maybe it's the structure wine. I get this all the time in the context of, I'm going to say, Bitcoin and crypto. Why do we need it? Right? Why do we need the Vixx, right? What is the utility value in terms of, and by the way, part of my argument is, why do you need the derivatives that exist around stock ownership, right? Because nobody votes their shares. It's a theoretical ownership and nobody really, follows through. So, I mean, it's all interrelated in my mind. But what's the use case in terms of the Vixx?
Yeah, Jim, I know you've got some very strong arguments in this, but I'll give just my one, and it's sort of it's more of a philosophical case, and it's literally, why is there a market for insurance in the house insurance or boat insurance, or you could argue, well, yeah, we all like boats and they're physical things and we own them in houses and we need houses, but there's the value of owning that property is actually improved by the fact that you as an individual can hedge your position, or you can insure it. Now, I believe the derivative products that we're talking about and Vixx linked products are just that. They fulfill that sort of use case, and in fact make for a more complete equity market than you would have if you didn't have them. That's very high level, but I know, Jim, you've
No,
mentioned.
I think that's very well stated, and in the insurance concept again. I think the challenge with insurance in financial markets is no different than it is with cars and homes, right? you write this check to your insurance company. You say, God, why do I have to write this check to the insurance company? Nothing's ever going to happen to my house. Why do I have to have auto insurance? I'm a safe driver. And so a lot of people don't have insurance on their, stock portfolio because they don't want to pay the cost of it. And then they're hit with, a March 2020 drawdown or a first half of 2022 drawdown, and they call their advisor and say, what the hell are you doing? Why aren't you salvaging my portfolio? How come I'm losing all this money? Stocks are going down, bonds are going down. Well, because you didn't want to pay for any insurance.
And I think there's even you can even not take that argument a step further and just say, well, not everybody wants insurance all the time, but there is a value to having a market for that insurance that exists for when you want it. So I may be, yes, I want to self-insure my home, and I have the right to do so, but I like the idea that if I know the hurricanes are coming, I might want to pick up the phone and speak to somebody and say, what can you do? How can you? So that I think that's important. The follow-on to that, of course, and I guess would be your next question, which is, well, what's the value? What's the use case for the shorts? And I think the important thing here is that to have a complete market, there's one way we could go about this, and we could have banks and others issuing the long product to people. So the Barclays and the Credit Suisse could sell this stuff and then just take the risk on themselves and say, we take the view that some people want to be insured and we'll just we'll shoulder the risk and maybe we'll reinsure it internally or with others. Doing it with a long and a short product effectively gives people the ability to participate in both sides. So if you want to become a member of the Lloyd's in London syndicates, you want to say, I want to risk $5 million on this situation, because I think in general people overpay for insurance. It allows that to take place. It then makes the market scalable to, well, infinitely scalable, I guess, because there's ultimately at a price there'll be as many buyers as there are sellers. So yeah, I mean, for me that's always been the value of the options market, the value of the derivatives market, and the value of the sort of Vixx-linked market, all rolled into one.
So to me, the challenge of thinking of the Vixx as insurance is that I think of insurance as a perennial staple. It's always there because you never know when you're going to need it. You don't go buy car insurance after you wrecked the car. But to Jim's point earlier, there is no product that is a buy and hold Vixx product. So how do you have forever insurance that's always there, but you can't buy and hold and have it always there? I don't understand how do you implement this as insurance?
I think Jim's point when he said it's not a buy and hold, it's not a buy and hold if you would like to see a consistent return from it. Just like buying and holding insurance isn't giving you a consistent return. And I'm sure 99% of people never have a major claim on their homeowners insurance, and you hope you don't. But you do pay however many thousand it is to take that cover. So I think Jim's point, the analogy is still there. It's just that I think he's saying it's not buy and hold if you expect to make a profit out of it. It's buy and hold if you realize you may need it one day. Same as the insurance analogy.
Well, and there certainly are offerings, if you will, and investors who allocate a budget to some form of insurance, and that may be put protection, that may be we have indices for these things. I put out on Twitter one of the problems this year is that put protection and Vixx calls haven't worked because of the nature of the decline we've had in the market. But yeah, I think you can keep the insurance in place, but you have to budget it. And you also have to understand that if you do have the insurance in place when the house catches fire or when the market tanks, what do you do when the insurance goes, as Stuart pointed out with TVIX in March of 2020, if you paid 40 and it goes to 1,000, what do? Do you just keep it there? Well,
yeah, you got to monetize and cash out of your insurance policy at the right time. And I think that's difficult it's difficult to judge, and that's people that are making those decisions. It's always a tough one to make. But
one of the recurring conversations among so-called volatility experts is that monetization question. If you have the convexity in place and good things happen, and all of a sudden, your investment in insurance has paid off, what do you do with it? How do you monetize it? Do you monetize it all at once? Do you scale out? Do you and it's not easy, right? Because everybody around you is panicking. As soon as you think, I tripled my money, I quadrupled my money, I got to cash it in, and then it goes on to be a 10x or a 15x.
I think some people often think about it as a liquidity. It's kind of a liquidity hedge. If you are trading the portfolio, it's good to have things that are outperforming in a way where you can sell, and find liquidity, because at those moments, a few things are happening. One is maybe you're panicking and very concerned about the overall value of the portfolio, but opportunities are also appearing. And I think people who've run tail hedge type strategies and funds and whatever, we'll talk about this in this way. It's in those moments of market correction that say, it's neat to know that there is a sleeve that suddenly blows up in value, that you can then take some of that cash off the table and then go and put the money to work. Maybe it's something that you had to liquidate because there's something you have to go and pay for. There are ongoing expenses that you need to cover. But maybe it's just an opportunity just appeared that's once in a 10-year opportunity. I'm going to take that and put it straight into that now. And it's these sort of ways that I think people think about it.
But the dirty secret is that if that's a sleeve that's managed by somebody else, they're probably not going to be the one to call you up and say, we just 10x'd our sleeve of your portfolio. What do you want to do with 90% of that?
Yeah.
Wait. I'm going to interrupt on that one, because there's a guy, everybody knows the guy, right? Sorry about that, Cynthia. But the guy named Rob Emmerich, who has that strategy that we're talking about, right? That when the market absolutely craps to bed, he's long the options on that are typically out of the money that go spiking up, and that's when his argument is that's when that dollar value on the VIX is worth exponentially more.
Well,
right?
I don't want to get into too fine a point, but the way XVol is structured, he's monetizing the hedge and putting it into the underlying. So it's a closed loop, as opposed to a pension fund that has a tail risk manager who, goes from 1% of the portfolio to 15% of the portfolio because they did their job. But it's up to the pension fund manager to call the tail risk manager and say, give me the money. I'm going to put it into stocks.
And that part's often forgotten, because the tail hedge manager's just gone from having 100 million of the pension fund's money to $1 billion, and is thinking, well, that's good for business in the long run. There's no point encouraging the guy to sell it and exit. So, but yes, managed correctly, those tail hedge strategies. And of course, there are a lot of guys out there that are doing it very well. They manage well. Have a piece of your portfolio that covers the need for liquidity at times. Nobody wanted to be selling equity in April in 2020. Perhaps many of us did, but the reality was, you didn't want to. And it would have been great to be the other way around and say, well, 10% of my portfolio is presently worth 40% of my portfolio, and I'm now putting 30% of that into equity at this point, right. And then make out like a bandit. I mean, I've certainly heard it. Certainly heard stories of people who've done that and been successful. But when is the bottom? Is Jim's point, right? You know,
Wait,
vols
you're
doubled.
saying
You
market
think, well,
timing
that's
is
it.
hard?
Yeah.
Yeah.
Oh, market timing's easy.
Hey, so we're approaching the top of
But
the
no,
hour. I wanted to ask, or go back to the very beginning, Stuart, and not to give away your IP or what comes next, but I just want to talk a little bit about innovation and accessing the Vixx and volatility. You know, where is there room to innovate here? Is it in different math, different algos, or is it in actually different structure? So we can have one final drink tonight.
Cheers. Yeah, I think the end users of volatility products are not interested in the math, sorry, in American terminology. What they are interested in is a product that behaves in a way they want it to and sort of does what it says on the packet. So I think there's a lot of confusion about Vixx, what Vixx is, what Vixx-linked products do. You know, I've been asked 1,000 times, you know, why can't we just buy Vixx itself, right? Why can't you actually just buy the Vixx? And there's sort of complex reasons for that. But that all stems to the way the Vixx was designed when it was first designed. It was designed to be, you know, as David said, you know, like many indexes, it was designed to be an index, not designed to be an investable index. That really wasn't the plan. So I think the opportunities in the future are you know, finding products that do what investors want them to do what investors expect them to do. If the maths behind it is incredibly complicated, I actually don't think that's necessarily a problem for the user. That's a problem for the manager who has to deal with it and manage it. But the end user wants it to do, you know, if I could say to you, I found a very complicated mathematical method, and this does exist actually, that where we could actually track the Vixx, the end user would say, cool, it's Vixx, that's all I wanted. Now, on the other hand, the advisor, whether it was us or someone else, trying to put that together and manage it would be so insanely difficult to do. But then again, yeah, the end user, what do they care? It's the cogs are moving inside, you know, as long as it does what they want it to do. So that's where we focus. We're very aware of what investors want. We have some solutions we think will work for investors, and we're getting things in place to be able to bring those to market in, you know, this year and next year. You know, some of those will be innovative in a way that investors will perhaps not know what it is at first. You know, I think when the Vixx futures were first announced, you know, I think there was a lot of questions of, you know, why would we want to trade Vixx futures? They seem around, but at the end of the day, they became very popular.
Mm-hmm.
Yeah, watch the space.
We'll be watching. Well, guys, I think we should wrap it up. It's 5 o'clock Central, 6 o'clock Eastern. So I want to thank you guys again. Thanks, Stuart, so much for coming. Thanks, Jim. And on behalf of the ETF Think Tank team, thank you everyone who joined us. It's always a pleasure. And we will see you next week. I don't know who the guest is yet, but, you know, edge of your seat, guys. It's coming.
Thank you.
Thanks. Bye.
Thank you.
Roger.
Bye.
Pleasure.
Thanks, guys.
Thank you.